All right, Seth Bradley. I met most of you. I'm a securities attorney by trade. My law firm is Raise Law. Shout out to the Raise Law team who all traveled with us today. So awesome. So come meet us if you haven't already. I don't know if we have any more hats. We're probably out. You guys should have came and met us earlier than that. A lot of folks already have talked about why you should raise, how you should raise. All those types of things. Talked about the real estate market. Are we at the bottom? Are we at the top? Like, what are we doing here, right? But I'm a securities attorney, so I'm going to talk about structure. I'm going to talk about decision making. A lot of the conversations I've had this weekend are around, really simple. Like, how do I structure my deal? A lot of folks are just asking that question. So I thought I would pivot to something like this so you guys can walk away with some choices so you can move forward with the raise and stop overthinking it and launch, because you don't want to just get stuck in this analysis paralysis, which a lot of folks do. But you all are action takers. You're here. You paid a lot of money to be here, and I want you to launch your next fund or your next syndication. So I am an attorney, but I'm not your attorney. Of course, some of you actually, I am your attorney, but for those of you that I'm not, maybe we will be. We'll see here. Let's see. But always seek your own counsel. Whether it's an attorney or CPA, your financial advisor, always seek counsel. Always get another opinion on things, especially in securities law. We deal with a lot of gray areas. So, you'll hear differing opinions. Dugan was up here yesterday. He might say something that's a little bit different than what I say. There's a lot of gray areas. A lot of this stuff hasn't been litigated yet. We've been in an awesome real estate market from, the crash in 2008 all the way up till about the end of 2022, when we're in the lull. But all those deals were great. There wasn't a lot of litigation. There weren't too many problems. There were really happy investors. So no one got in trouble, right? So just know there's a lot of gray area, and that's why you need securities counsel. All right, let's go into some compliance. Just kidding. I wanted to put my baby girl up there. She's 7 months old, so I'm a new dad and really loving it, and she's fucking adorable. Look at that. So just always remember your why, right? Always remember why you're doing it. It's not just to get rich, not to get wealthy. Of course you're doing it for that too, but remember your why and why you're doing what you're doing. A little bit about me, blue collar mindset. I always used to lead with this. I grew up in West Virginia. My dad's a retired coal miner. My mom's a retired grade school teacher. So I was always taught, what's the best way to trade your time for money? What's the highest dollar use? And that's all I knew. To me, where I grew up, the only people that owned real estate were the local politicians, the Manchin family. I don't know if you've heard of them. They were kind of in the political stage there for a little while, because he was making Joe was making the deciding vote there, because he was was he a Democrat, was he a Republican? So he was right in the middle of it. They're the only ones that own real estate in my hometown. So I went and I said, well, what's the best way to trade your time for money? Growing up, it was to be a doctor, in my opinion. So I went to medical school. I went for about a year and a half, dropped out because I absolutely hated it. I was actually in school for 11 years, college for 11 years, and I'm not a doctor. So that's really unfortunate, because I got my MBA and then I went to law school and a few other things there in between. But all in all, I've been through basically all of the colleges that you could possibly go into. But I did well in law school. I got a big law firm job, kind of living the dream, so to speak. But you've got the Scotch happy hours, you've got all that stuff, and you're trading your time for money, and it's just a grind, and it wears on you. So I started looking at what else is out there. Well, I think many of you have done the same thing. Read Rich Dad, Poor Dad, maybe got in the Bigger Pockets forum, that sort of thing. Started investing in real estate one way or another. I house hacked into a duplex. Even though I was a securities attorney, I still started with house hacking into a duplex. That's just, that's how you do it. You step and step and step, because I didn't know any better. Even though you all don't necessarily have to do that if you haven't already. You can jump right into raising capital for huge deals. So I started raising capital, syndicating, and jumped into entrepreneurship, growing a law firm, and here we are today. There's John Denver, Country Roads, of course, and my wife, Allison. And let's see what else we got here. And now, so we've done 750 funds and syndications. We've done 9 billion in transactions, representing 3 billion in capital raise for my clients, partners, and for myself. Very, very small piece of that for myself. Securities attorney, chief legal officer for a company called TribeVest, who some of you have heard of. Again, a big thing here is in securities law, and this group is probably a little bit isolated, but there are so many securities law firms out there. You only hear about maybe like 4 or 5 of them, right? Because we're in this, I like to call it kind of this influencer community. But I worked at DLA Piper, huge law firm, top 3 globally ranked firm. You're probably priced out of them, right? Like they're going to charge you $100,000 for the same documentation that we'll charge you for, which is going to be way less. We can chat about what that's going to be. But there are lots of folks out there, or lots of firms out there, but very few of these smaller firms have the big law pedigree. It's hard to get. It's hard to get. So here's the question, though. Should I do a fund or a syndication? It seems simple. It seems easy, but literally all these calls that I get on with you folks, like everybody's like, man, which one should I do? Which one should I do? Even though you might have multiple deals, should I do a bunch of syndications? Should I do a fund? And analysis paralysis is killing your raise because you just need to launch, need to get going. So the first question you really need to ask though is, can you get paid for bringing people into deals? Because the general rule is you're not allowed to raise capital without a license. Just like I can't practice law without a license, you can't be a doctor, you can't practice medicine without a license. Same thing goes for raising capital. You have to have a license, you have to be a broker-dealer, you have to be an RIA, unless you find an exemption. So we live in the exemption world. We need to find an exemption. Most of the time, it's because you're a GP, you're a lead sponsor, you're an owner, operator, you actively run the deal. So you earn your capital, you earn your fees through the deal. You're the lead sponsor, you're the operator. Sometimes you'll hear this as the issuer exemption. It's your deal. Most of the people in this room probably sit there, but other people might be an aggregator, so a capital partner. You bring the capital into the deals. Many of you also sit here, or if you're a lead sponsor, you really want these people raising capital for you, for your deals. And then you've got to figure out how to bring them in compliantly, right? And we'll talk about that as well. And this is the one with the most traps and the one with the most gray areas that I mentioned earlier. So I'm going to give you the structured decision engine. 3 gates, 3 questions. You should be able to answer these 3 questions pretty easily when we walk through them. And you can decide if you're going to do a fund or a syndication, or if you're an aggregator, it gets a little bit more complex, like what kind of fund-to-fund you're going to do, that sort of thing. But gate number 1, is it even a security? You have to decide, is it a security? Do I need a fund or a syndication at all? Maybe I don't. Maybe I structured it a different way, and I don't even need a fund or a syndication. But let's say you do. Or it is a security. So then you got to ask, are you the operator or aggregator? That's pretty easy. You guys know what you do. Are you the lead sponsor? Are you the operator? Or are you a capital partner? And last, one deal or many. And then we can do a little subset thing here after that. So here's the whole toolbox, the ways to structure a raise. So, and sometimes you'll see syndication, you'll see fund, but there's some others up here as well that I know you've used before, right? So fund to funds as well, that one gets a little bit more complex. We'll talk about why. But you've also got the joint venture. A lot of folks out there use the joint venture, or they call it a joint venture, and it's not even a joint venture. And we'll talk about that too. And then a note of deed of trust. I know there's a lot of developers out here, folks that are doing luxury, single family. So maybe you borrow for each single one. You get one investor lender. So you get a note, you get a deed of trust, kind of a traditional structure. Well, the funny thing about that is it's actually a debt is actually presumed to be a security. You have to show that it's not a security. So gate number 1, is it even a security? This is the legal framework, the Howey Test. So you want to sound smart in front of people, you call it the Howey, you're like, all right, are we doing a fund of syndication? Are we doing a JV? Talk about the Howey Test. This is what lawyers look at. That's the case. 4 prongs: an investment of money in a common enterprise with an expectation of profit from the efforts of others. So investment of money, easy, right? You're going to take money from somebody, whether it's debt, whether it's equity. You're taking investment of money, that's easy. In a common enterprise, maybe that's through an agreement, maybe that's through an entity, an LLC, or a limited partnership. Pretty easy as well. With an expectation of profit, did that person give you money and expect a return on that capital? Pretty easy there too. The 4th one is really the one you really need to analyze. So from the efforts of others, profit comes from somebody else's work. They gave you money and you're doing all the work, not them. They're not doing anything. If they are passive, if they expect you to do all the work, the efforts of others, then we've got a security. So there it is, the JV trap. You call it a joint venture, you bring in a partner, right? In a real joint venture, everyone has real authority. You can't just bring somebody in, they give you money, and then you don't give them any rights. You say, oh, I'm going to do everything, don't worry about it, right? They have to have hands on the wheel. They have to have decision-making processes. They have to have management, at least over major decisions. They have to have access over financials. And they have to have the ability to remove you as a manager. Profit from their own efforts. That's the key there. They're actually participating in the deal. Maybe they're not the one swinging the hammer. Maybe they're not the one managing the asset. They're not the one signing the loan necessarily, but they do something, their own efforts. So voting, managerial rights, their efforts. Howey prong number 4 fails, not a security. The disguised security is just that, right? One partner brings only money, passive partner that has no control whatsoever. They just give you money and expect a return on their capital, and they rely on you and you only to produce a return on that capital. Promissory note, deed of trust, we talked about that, and it's interesting because a lot of you folks are developers and you've done this before. You've used a note and a deed of trust to borrow funds from your investors. It is presumed a security. You have to show that it's not a security. I think people are surprised by that. One lender, one loan, secured by real estate, probably fine, right? Probably fine. But when it starts looking like a security, meaning let's say you bring more than one investor into that note, you bring 2, 3, 4 people, fractionalized. Maybe you do this over and over and over. Maybe you have a pitch deck for it. Maybe you put it out there into the public and you say, looking for a lender for this deal. Bring in a couple for each one. It starts looking a lot more like a security, and it probably does. This is one of those kind of gray areas. We use what's called the family resemblance test to figure that out. But the more that it looks like a security, the more that it looks like an investment, the more that it doesn't look like just a lender that's in the business of lending money, the more it looks like a security. Gate number 2, are you an operator and aggregator? This one's pretty easy. If you're the operator, you find, fund, and run the deal. You raise capital, you sign the loan, you execute the business plan, you develop, you asset manage. You know this, you're doing this. You get paid through the deal, through fees, promote. Real non-capital raising activity. Yes, you can raise capital for your own deal that you're an active partner in, but there have to be non-capital raising activities that you're completing. The aggregator, maybe not. They're the capital partner. They're not in the operations. Yeah, maybe they signed as a member of your LLC, but are they actually doing anything other than raising capital? Lots of times they're not. But the good news is there are compliant paths that exist. But the bad news is people have abused this pathway time and time again, especially over the last 8 years or so. So getting paid to raise the compliant paths, you've got a fund of funds, an SPV. Those have been really hot over the last couple of years. A genuine co-GP or a joint venture, or even a finder. And we'll talk about finder because a lot of folks will use that as well. Really difficult to navigate that exemption. It's not really an exemption. It's an SEC no action letter that birthed that, and it's really difficult to do. You won't find a securities attorney that will tell you to try to do that. The trap, the code GP in name only, if all you do is raise capital and take a cut, and especially if your compensation is based on how much you raise, so you didn't agree up front, you said, all right, well, I'll give you 5% of the GP. You offer this to one of your capital partners. You say, I'll give you 5% of the GP. And you anticipate that they're going to raise $500,000 for you. But come to find out, they're not very good at capital raising. They raise $100,000 instead of 5. You say, I'm not giving you 5% now. I'm going to give you 1% because you raised 20% of that. That's transaction-based compensation. That is illegal. We say non-compliant. Sometimes it sounds a little bit softer. But it's actually, it's illegal. You can't do that. You cannot do that. And because they're part of your company, you're in trouble. Not just them. You're in trouble because you brought them in as a member to your company. So gate number 3, one deal or many, syndications versus fund. You guys know this. Even though you have multiple deals, you can put them all in one. You can put them in a fund. So pooled capital across multiple assets. There's many different kinds of funds, blind pool, semi-blind, seed deals. You seed the deals, you seed your fund with a deal or two. That would mean semi-blind because the investors are semi-blind to what they're investing in. They see some of it, not all of it. Raise once, deploy repeatedly. Investors bet on you. So you need more trust. So that's the key there. It's harder to raise for a fund. So that's the thing. A lot of folks will kind of jump into this really quickly. They're like, really excited. Let's raise a bunch of capital. Let's start a fund. I just want to have, a few $1,000,000 in the bank so that I can pick and choose where to invest. I've got lots of deals. It's hard to raise for a fund if you haven't raised before. Now, if you've got experience, sure. But just know if you haven't done it, it's hard to raise for a fund because you have to get that investor trust. They have to give you money before you have a deal. And then you take that money and invest it in something. So they have to take your word for it, that it's going to be something they want to be part of. Compared to a syndication, it's a GP that finds funds and runs one asset. LPs bring the passive capital, but they don't have any control. One entity, one asset. It's security. We talked about that. You have to find an exemption, 506B versus 506C. But another advantage that we don't talk about is asset protection. In a syndication. It's high. It's a siloed security. It's very similar to if you buy houses one at a time and you put an LLC, or you put a house in each LLC instead of putting a bunch of houses in one LLC. Kind of the same concept. Same concept here. And the ease of the raise, it's easier. The investor can underwrite the deal. They can look at the property. They know exactly what they're investing into. But again, the trade-off is flexibility, right? As a capital raiser, you strive to probably end up in a fund. You want to have a fund where you have all this capital ready to go. You can make really powerful, strong, confident offers because you know the capital is ready to be deployed. You don't have to worry about getting it under contract and then raising. You've already got the capital ready to go. 1940 Act traps. You hear a lot about this nowadays because many of the funds that we do are structured as fund of funds. So whenever you get into fund of funds, we're not just talking about the Securities Acts. We're talking about the Investment Company Act, the Investment Advisors Act. It gets more complex. And the reason this comes up is because the fund of fund doesn't necessarily invest directly into, let's say, real estate or into a business. It invests into another fund or another syndication. So you all that are lead sponsors out there and you're bringing in fund of funds, that fund of fund manager has to deal with this as well. You don't necessarily have to deal with this, but they do. So they have to also find not only a 506B or a 506C exemption, they have to find exemptions to the Investment Company Act, the Investment Advisors Act. Securities framework, kind of backing up a little bit. You pick your structure. Here's how you actually raise into it. There's two doors. There's only two options. You either register your security or you find an exemption. There is a third door. The third door is it's illegal. So it's not really a door. So you either register it, you're either Elon Musk, and you register it. It's an IPO. That's what we're talking about here. We're talking about an IPO. We're talking about a public offering. You're not going to do that. So we live in the exemption world. We're trying to find an exemption. That could be 506B, 506C. You guys have heard about that. You can do a Reg A+, Reg CF. There's a few others. Mainly, you're going to be living with those those four, probably those three. Reg CF is kind of a nightmare. I've done a raise in that before. 506B versus 506C. You all know this. I'll touch on it real quick though. 506B, you can bring in up to 35 non-accredited investors. So that's the big advantage. If you have folks that are not accredited, you've got to go 506B. But you can't solicit or advertise, so that's the huge thing. So you can't go out to social media, you can't run meta ads, you can't do kind of all these marketing and advertising funnels that Marcin talks about. Can't do it under 506B, but you can have up to 35 non-accredited investors. Sometimes you'll hear this as a friends and family, that sort of thing. Another advantage is investors can self-certify. So you don't have to collect a verification letter from them. They can just say, hey, I'm accredited, or hey, I'm sophisticated, and you can take their word for it. 506C, accredited investors only. So that's the big thing, right? You can solicit, you can advertise, you can talk about it, you can come on the stage, you can pitch strangers in a room, doesn't matter. You can talk about your deal, solicit, advertise publicly, go on a podcast, go to your real estate meetup, whatever you want to do. You have a lot of freedom with 506C, so it's great. But again, accredited investors only, and you've got to verify their accreditation. So here it is, run the engine, right? The structure picks itself when you do this. Is it security? That's a big one. It's a little bit complex as we talked about, like, is it a deed of trust and a note? Is it a true JV? Is it a true joint venture? Does your money partner have real voting rights or real managerial rights? Can they kick the manager out and you can hire somebody from outside to manage? Probably not. Probably not, right? Or do you have a security? So do you have a fund or do you have a syndication? And then you've got to find an exemption. Are you the operator? Are you the aggregator? You all know that. Sometimes you're both. Sometimes you're both. I'm both. Do a fund of funds. Is it a real co-GP or JV? The finder tightrope that we talked about. I will mention that for the capital aggregators out there, we're in an administration period now where they are loosening the reins. They're trying to open up the markets. So they're loosening the securities framework. They're working on a finder's exemption where you can actually get paid transaction-based comp. You can get paid based on how much you raise. And that would be a huge, huge unlock for people. Whether you're a lead sponsor bringing in people to raise capital for you, or whether you're one of those capital partners that wants to raise capital from investors, if they pass that, and they just mentioned it, I believe in April of this year, they brought it up again. Now we'll see, because they never give us anything we want. They just like to argue over shit. But maybe they will. Maybe they'll give us something we like. Maybe they'll give us daylight savings time. They'll get rid of it. I don't know. But if they do, that will be massive. That will be massive, because then a lot of the structure kind of falls away. Maybe you don't have to do a fund of funds anymore, right? Maybe you just have a finder's agreement and you can get paid for bringing in your investors. So that would be huge. That would change the market. And then how will you raise? So 506B, 506C, you've really got to look at your investors and in your avatar that we talked about this weekend. Who are they? I would highly recommend, if you can raise only from accredited investors, to only raise from accredited investors. They can withstand, a bad investment. They're not going to bug you every single day. Maybe the 506B, that might be their retirement. That might be their last $50,000 or their last $100,000. So they're going to care about it. They're going to bug you. They're going to email you. They're going to ask you how the deal's going all the time. 506C, if you can, accredited investors only. Now I'm going to leave you with this. $65 trillion. That's the amount that's projected to be flooded into the private markets by 2032. That is huge. That's huge. I don't have my notes in front of me, but I believe we're at 15 today, and we were at 5 10 years ago. We'll be at 65 by 2032. You've heard about it. People want exposure to the private markets. They want real estate in their portfolio. They're asking their financial advisor, hey, can you get me into one of these deals? At TribeVest, we're trying to reach out to these RIAs, these financial advisors, and get them to raise capital in a fund of funds because their investors are asking for it. They want it. They want exposure to real estate. Yes, public markets have been great. But guess what happens when the public markets aren't great? And we all know that they won't be great forever. They're going to go down. That's what the stock market does. That's why we invest in real estate. $65 trillion. Every so often, there's a new capital raiser born. In the 70s, and there's technology that's involved to really open it up, to give access to the folks, to their network. In the 70s, there was a broker-dealer, and the invention of the computers gave them the technology they needed. NASDAQ launched. In the 90s, it was the RIA, the financial advisor. The internet gave everyone access to that, for them to be able to bring in all of their network, all of their investors. And today, we're doing it right now. We did the whole CodeGP thing here, and then we had the slowdown. But if you remember, 5 years ago, we didn't really have AI. Like, we're in it now, and we're like, man, we use it every day. 5 years ago, I mean, there were some people that were like, oh, there's this thing, but it didn't exist. It didn't exist. The technology is here that's gonna give all the capital partners, all these people that wanna raise capital, all these folks that are not broker-dealers, they're not RIAs, they're not licensed, but they wanna raise capital, they have a great network, they wanna get involved in the $65 trillion market. We call them the ICA. Liz trademarked it for us. Independent Capital Aggregator. That's what we're calling them. We'll see what the market ends up calling them, but really this is unlicensed capital raisers. Maybe they use this new finder's exemption one day. They were probably a co-GP a few years ago. Right now, they're fund-to-fund managers. But the ICA, the Independent Capital Aggregator, we finally have the technology that's going to line up where they can bring this mass to the market. Right now, you're in the room, whether, again, you're a lead sponsor that needs capital, you're going to run out. Like, you start a fund or syndication because you don't want to use your own money anymore. You're out of your own money. You want to scale. At some point, you're going to hit a ceiling where you can't raise any more capital. You can't even scale past that. You're like, man, I'm doing everything I can. I need to bring some other people in, some capital partners, capital aggregators. So whether you're a capital aggregator or you're a lead sponsor, you're going to be part of that $65 trillion. All right, we saw it coming. We were ready. I wrote a book on funds and syndications, a lot of the stuff that we talked about today. Please scan that, get a free copy. It's not quite ready yet, but it will be soon, and everybody in the room can get a free copy if they scan it today, and we get you in the system before the weekend. All right, folks, eat, sleep, raise, repeat. $65 trillion. If you're not excited about raising capital, I don't know what's gonna get you excited. Like, this is go time. So let's fucking go. All right, thank you.
There might be a couple questions. Thank you, Seth. That was awesome. So we've got about 10 or 15 minutes for some questions. So let's get some non-legal legal advice.
Hey, Seth. So my name's Alex. So before I give the context and question, I give you full permission to slap me silly for being stupid at the time. All right?
Well, you got the hat on, man. You've been rocking it all weekend.
All right. So before I had launched a 506c fund, I had pitched a deal for a mezzanine debt for a TIC project, and it turns it into a condo conversion project. Okay. And long story short, at a Shark Tank event, I have raised about $450,000 in about 10 minutes after a 10-minute presentation.
Nice.
So the question is this. Before I presented the deal, I already knew about 75% of the people there. I already checked out the list. The event host had also verified with me and asked me the question, hey, I looked at your pitch deck. Is this a 506C or 506B offering? And my response at the time was that either this is not an offering or this is a non-offering. Is that a correct way to say it, or am I being too clever at the time? Or was I being too clever at the time?
So you're trying to categorize it as not an offering? So
That's why I responded
because it was probably a 506B later?
Because I'm not sure. Because this is essentially a joint venture partnership at the
Okay.
time, right?
Okay. If it's a joint venture, you're
Yep.
good. Like if it ends
Good.
up being a joint venture and every person that gives you capital
Right.
is an active partner in the deal,
Right.
then you don't have to worry about it. You're not talking about any of this stuff. You're not talking about, well, can I disclose it? Can I talk in front of people? It's a joint venture. They're not technically investors. They're partners.
Okay.
They're active partners in the deal. So if it's a joint venture and it really is,
Yep.
then you're good to go. You don't
Okay.
have to worry about filing for a 506B, 506C, any of that kind of stuff.
Right.
We're not dealing with that anymore.
Okay.
So that's the great part about a JV, but a lot of times, even if you have one passive investor, so you've got maybe 4 or 5 guys that you get together and you're active partners, you're making decisions, and there's this guy that I know that wants to put in some money, and you don't give him any rights. You have one passive investor in that deal. It's no longer a joint venture. It's a security, and you've got to go through that whole framework. You got to file an exemption.
Okay.
Now, I'm just curious, out of this room, who here would rather be a fund manager or capital allocator rather than an operator? Just curious. 1, 2, 3, 4, 5. Seth, do you want to talk about TribeVest for a minute and just how that could be an opportunity for them to explore and what that structure looks like?
For sure.
Because not everyone wants to be in the weeds with operations, so thought that could be an opportunity.
Yeah, for sure. So if you want to be a lead sponsor, you are a lead sponsor, and you have the deals, you're operating, then come talk to us at Raise Law, because that's what we do. We'll put together the fund, the syndication, whatever you need, all the kind of what I call top level structure. And when we're looking at it from the fund of fund level, we call that the target deal. But at TribeVest, we really specialize on one thing, and it's fund of funds. So these are for capital allocators. These are not for operators, not for people, not for lead sponsors, not for the people actually buying the deals. These are people that just want to raise capital and place it in somebody else's deal. That's what TribeVest does. So we specialize in that. It's low cost. So I'm sure you all have talked to us or talked to other securities attorneys. You know, we charge anywhere from, again, you know, maybe $15,000 up to, if you talk to DLA, maybe $100,000 for offering documents. At TribeVest, it's only $5,000. And that's not just your offering documents, that's everything. That's your entity setup, that's your business banking account, EIN, investor portal, your taxes, all the securities filings, all those things that you need. It's cheap, it's $5,000, but you're really limited in what you can do. It's highly templatized for a reason, because it's not a law, because TribeVest is not a law firm. But if you're raising capital for somebody else's deal, it's a great fit. We set up a fund of funds in 5 business days, and then you can invest in somebody's deal. So even if they've got a quick close, we can get it done fast.
For context, one of my members, I won't say his name, just out of respect for that, but he raised $32 million or something to that tune last year. He's got about 8 funds on the go, and he just said, you know, as a solo operator, it's only been possible because of TribeVest. So he really attributes his ability to work that swiftly and having that structure and support behind him, being able to do that. So he obviously has to partner with solid operators. We do have some information in school on like how to vet operators. So obviously, if you're going to put your reputation on the line and raise money, you have to make sure that it's solid. But TribeVest is obviously a great resource to make that happen if that's, you know, the role that you want to play.
Yeah, I'll say his name, Dylan Reach. We talked about him the other day. He's one of our star students. If you guys haven't talked to Dylan, he's the most humble, awesome guy in the world. He's raised probably close to $50 million in the last 2.5 years. He's done like 30 TribeVest SPV fund of funds, and he's incredible. He's incredible. If you guys want to learn how to raise capital without pitching, without selling, just being a steward of capital, talk to Dylan. He's the man.
Like a unicorn. I think he closes 90% of every single person that he speaks to. The other thing I'll suggest that I've said to my members, but what he's done instead of just trying to go out and find hundreds of people to talk to, he's aligned himself with some tax strategists and CPAs that give him a lot of referrals because they work with his ideal investor avatar. So yes, he has his own network, but he's also made some very strategic alliances. So for those of you in your community, when you're considering your Fast 50, don't just look at them as possible investors, look at who could be connected to your ideal avatar, because you can obviously focus on those relationships, and it's easier to have 5 people sending you dozens of people than to go out and find dozens and dozens of people. So just keep that in mind when you're considering the people that you know that like, know, and trust you.
Yeah, and he does kind of all the things, the social media. I don't think he's running ads or anything like that yet, but it's referral based. Like, it is communication, transparency, talking to his investors like people, keeping them updated on deals, whether they're good or bad, and gets referrals over and over. Repeat investors and referrals. That's the name of the game.
Questions here? Yeah, coming in. There, you guys can just share the mic. There you go.
Thanks, Seth. Actually, I have a few questions. I don't know how much time we have. But first one is, can you talk about the difference between a co-GP and a JV?
Yeah. That's the end of the question?
No, I have a few more questions.
They're very similar. So they're very similar, right? A true joint venture is actually not housed within an LLC or a partnership or an entity structure. A true JV is really just an agreement. So it's an agreement between two parties. So let's say you have one entity, another entity. They have an agreement, a joint venture agreement, so they agree on all the terms of that relationship. That's a true joint venture. A lot of times people will they might put an LLC together and then partner with some other people and everybody's a member of that LLC and call it a joint venture. That's really just an LLC. But a true joint venture is just an agreement that kind of governs the relationship between the parties. Versus the co-GP, they're actually part of an LLC. They are in it, right? So you've got an LLC or you've got a limited partnership and and you have multiple people in there that are running the deal or raising capital. I don't even like the term co-GP. Like, that's a new term. Like, if 10 years ago you would say co-GP, like, what the hell is a co-GP, right? There's really no such thing as a co-GP. You're either a GP or you're not. There's no there's no qualifying that. There's no saying, oh, well, they're just raising capital, so they're a co-GP. You're either in it or you're not. And it's just, it got abused, because that's what we do as entrepreneurs. We just push the limits, we push the cards. You know, there's this one money partner, then there's two, then there's three. Then you saw people doing like 20. You have like 20 co-GPs, and you're like, what are they all doing? They're not buying this property. They're not operating this. You don't need 20 people to operate a 14-unit property in Louisville. Like, what are they doing? They're raising capital. And probably if you look at the documents and you look at the bank transactions, which the SEC or a state commissioner will do, if you get in trouble, if your deal goes bad, they're gonna look at all this stuff. They're gonna look at everything. And they're gonna see that, oh sure, maybe you had this co-GP agreement up front that said, yeah, I'm gonna be doing this, I'm gonna be doing investor relations, all these things, but at the end of the day, you got paid for raising capital, and you got paid on top of that how much you got paid based on how much capital you raised, more or less.
On the JV side of things, you said one of the items required was removal rights of the manager. Is that for cause?
Yeah,
how is
you
that
can
set?
make it pretty steep on that one. And again, it's not like you have to have that. Like, it's one of those things where it's kind of looked at holistically. Like, what are the, do they have major decision rights? Like, for instance, selling it, like if there's one asset, can you sell the asset without their approval? That's a big one. Because if you can do that, then they're not really in control, because that's like the biggest thing you can do is just get rid of the asset in the business. If you can do it unilaterally, it's probably not a joint venture, right? And same, yeah. And so it's kind of holistic. Like, look at the major decisions. Like, can they see the financials? Do they have financial disclosure rights? And removing the manager is a big one. It's mentioned in court cases multiple times, but it doesn't have to be there. Some form of it. It might have to be for cause, and you can make it pretty steep, but.
Last question, if I have time. Can you talk about roughly the difference in documentation and potentially legal fees for a B versus a C?
Yeah, I mean, it's about the same. It's about the same. It's not like, okay, well, if I do a C, it's going to be a lot more legal fees, or vice versa. It'll be the same, as fee-wise. Yeah, so you'll hear about like a 506B to 506C conversion. Technically not true. I think it's just a fun way to say it. It's really two separate offerings. So you start your offering out as a 506B, you get in your 35 non-accredited investors, and then you shut that offering down. So we'll file an amendment to your Form D, shut the offering down, file a new Form D, but this time under a 506C exemption, and from that point forward, you can solicit, you can advertise, you can talk about your deal, but you can't bring in any more non-accredited investors. Now that does have added cost.
A follow-up to that, when does the Form D get filed in the process, ideally, and what's maybe the latest?
Yeah, so, well, the initial Form D should be filed within 15 days of your first sale. So the first sale of securities has to be filed. If you're going to start presenting the deal in front of a bunch of people, like deal specifics, like not, hey, I invest in multifamily in the Southwest, 100 units plus, you know, we've got this track record, this history, but you're not actually pitching the deal, that's okay. But if you start pitching the deal, if you start really talking about the specifics, the projected returns, those sorts of things, we'd really like to get that Form D filed before you start doing that. But really, the rule is 15 days within the first sale. And then if we're talking about the 506B to 506C, you'll hear some people say there's a cooling off period of 30 days in between, but that's not actually true. You just need a very delineated, demarcated, this one's over, this one begins. Sometimes we'll do it specifically in the offering documents. We'll put Class A as the 506B offering, Class B as the 506C offering, so it's very clear that we started, ended, and started again. Yeah.
Where do investment clubs kind of fit into 506Bs and 506Cs?
Okay.
We'll have a presentation on that later.
Cool.
So don't worry about that.
I wanted to take you back to the joint ventures. Are you saying that everybody that's participating in a joint venture should have their own entity? Or could you potentially even have like a couple people in one of the entities as long as it's member managed?
No, they don't need their own entity. They can be individuals. It doesn't matter.
As long as they're all
Individuals
active.
versus entity. Nope. No, it's better if it's member managed. I think that kind of skews towards, you know, everybody's actively participating, but you can still have it manager managed.
Okay, and for the co-GP model, especially those past, should we already always have a written agreement if we're going into a co-GP situation?
I would say so. So you'll do that up front, and that sometimes is called a joint venture agreement because it's just kind of an agreement to agree between parties. So it might be a co-GP agreement, it might be a joint venture agreement, and it basically just lays out like, hey, here's what I'm going to do. Most likely you're raising capital. That's why you're part of the deal. Let's be honest there. But you're also doing these other things, right? You're doing due diligence. I promise that I am going to fly to the property and look at it. Afterwards, I'm going to participate in every meeting. Like all the things that a real active partner would do, you're agreeing to those things. Maybe you have a specialty. Maybe you're a securities attorney. Maybe you're a CPA. You can provide tax services. Different things you can do, list them out in that agreement, and agree on how much you're going to get paid for it. Like that's the big thing. That's the big thing that I saw happen over and over again, is we have these agreements, we agree how much you're going to get paid. Lo and behold, they can't raise capital, and lead sponsor says, well, I brought you in to raise capital, you can't do it, I'm going to pay you less. Well, that's pretty easy to follow if you're the SEC or state commissioner. They're going to say, oh, well, you agreed up front for this. I see that this person brought in these 5 investors, and now it's less. That's pretty easy. They're not idiots. They're with the government, but they're not idiots.
Seth, question for you. On the fund-to-funds model, one of the securities attorneys I was talking to was talking about what kind of funds you can receive being in the funds-to-funds models, and said, hey, look, if you're actually providing any investment advice, you're limited just like an investment advisor to 1 or 2%. You can't take a back-end profit. How do you structure that? What kind of fees are you receiving as a fund-to-fund? What are the limitations around that?
Yeah, that's probably the most disputed. That's a great question. That's probably the most disputed issue out there today with fund-to-funds is you're dealing with the 1940s Acts, which we touched on briefly. Investment Company Act, really easy. Find an exemption for that. Typically, you're going to use a 3C1. You're going to use a 3C1, and you're going to have less than 99 investors or beneficial owners. So it's actually 100, but you are 1. So we say the 99 investor rule. So you keep it under that. That one's easy, unless you raise a ton of capital, and then it's like, all right, well, I'm approaching that limit. So that one's easy. The Investment Advisor Act is the one that's a lot more difficult, a lot more gray. You can't advise without an exemption. Typically, if you have equity under management of less than $100 million, the SEC doesn't care about you. So you're going to be under state blue sky rules. and their RIA rules. The safest way, and I'll start with that. The safest way to do this is you actually will file what's called a truncated form ADV with FINRA, and you'll be an exempt reporting advisor. And you actually can advise in a limited capacity. You can accept fees that you're talking about. That takes time, takes a little bit of money. You might have to pay your securities attorney to do that for you. And in some states, you can't do it at all because it's going to limit you so much that you're not going to be able to do it. You can only raise, let's say, from qualified clients or qualified purchasers instead of accredited investors. So maybe they have to have $5 million in net worth instead of one. So that severely limits who you can raise capital from. Most of us can't execute a raise with that. Another safe way to do it, flat fees. We don't base it on how much we raise. We base it on flat fees. So you agree up front, I'm going to charge $20,000 for this raise up front at close. Every year I'm going to take $10,000 to manage, to administer, to operate the fund. And then on the back end, instead of, let's say, a profit split or carried interest or promote, whatever you want to call it, success-based fee, flat fee. Not what we want, right? Like, we want it to be based on how much money we raise, how well the deal goes, but the safest way is to make it flat fees. Now, I'm not saying that's the only way, but that's probably the safest way, right? Outside of that, you can try to not advise, right? Like, you look at the definition of an advisor and you try not to advise. Also very difficult to do, but you can do it. Don't advise, don't provide your opinion, don't counsel, don't come up with your own projections. As a fund-to-fund manager, you take the facts that the lead sponsor gives you and you pass them down, funnel them through to your investors, and you don't make any decisions. You don't make investment decisions. You don't raise capital and then place it in a bunch of different deals. You do an SPV where the investor chooses to invest in one deal. They make the decision. All that capital goes to one predetermined targeted deal instead of you allocating capital to different places. So there's lots of nuances there. What's that?
As an advisor, what if you're doing a background check on the sponsor? Does that cause you to then be an advisor?
That's factual, right? I would say no. I would say no. It's factual. If you live in facts and not opinions, that's where you want to be.
Does Ray's Law represent if we do get a letter from the SEC or anything like that?
So we will start it out, right? So if we drafted a document, we did your filings, we are a transaction-based law firm. We don't litigate. We specialize in transactions, but we do have partnerships with litigation firms that this is their specialty. They specialize in litigation. We don't try to do everything great. We do transactional, they do litigation, and we're right there with you, right? Because if we drafted the documents, we did the filings, we advised you on how to raise the capital, then we're right there with you because we've got to provide, like, hey, why did you write it this way, or why didn't you disclose this or that, right? So we're there with you, but we leave it up to the real professionals that litigate every single day.